Hi there, folks. I want to talk a little bit about estate planning as well as irrevocable life insurance trust. Now, I didn't prepare for this video because I'm kind of not in the mood to prepare for this video. And you kind of get to a point to where if you know something, you know something. You just talk about it stream of thought. So this is a little more stream of thought than a lot of my short videos. Irrevocable life insurance trust, and I'll also talk about gifting. This stuff is important because today a couple will not experience any gift taxes unless they have over $27 million, right? Today per person, the estate tax exemption is around $13.6 million. So considering that if you have a couple, $13.6 million times two, that comes out to around $27 million. That is changing. And it's changing in a big way on January 1st, 2026, with the sunsetting of the Tax Cuts and Jobs Act. What is happening? What's happening is the exemption is going to be cut in half. So if in 2025 the estate tax exemption is up to say $14 million per person, let's say it's going to go down to $7 million per person in the year 2026. For people that are wealthy, that is a completely different scenario dying after 2026 than if they otherwise died today. So what can a person do? Well, first of all, we can get into gifting strategies. We know, most people know that $18,000 is what our annual gift tax exclusion is in the year 2024, $18,000. That means that you're not even on the IRS's radar if you give away to your kid, to whoever, $18,000 or less. Well, what happens if you give away more than $18,000, say $20,000? Are you on the IRS's radar? Yes, you have to be on the IRS's radar. You have to file a Form 709, which is a gift tax return. Or I forget what you call it. Let's just call it a gifting return that says that you've gifted something beyond the $18,000. Does that mean that you pay gift taxes for everything you paid above that $18,000, that $2,000? No, it doesn't. It just means that you use your lifetime gift exemption, which is the same as your estate tax exemption, right? So both of these are unified. Many of you may have heard of the unified credit. What does that mean? It means the estate tax exemption is $13.6 million, and also the gift tax, the lifetime gift tax exemption is $13.6 million. But whether in life or after death, it gets reduced by, how much in assets you die with. You know, obviously your exemption, you're not going to pay taxes until that gets reduced to zero. But also what's going to reduce both exemption amounts is the amount of gifts that you give over that $18 million, at least in this year, right? You're not going to pay a penny in gift taxes, however, if you give somebody $20,000 this year. Now, so gifting strategies, right, can be very beneficial prior to 2026. Why is that? Because the IRS has said, let's say you're a couple and you give away this year $26 million, and all of your gift exemption, all of your estate tax exemption, you haven't used any of it yet. Are you going to pay one penny in gift taxes? Are you going to pay one penny in gift taxes? No, you're not. You're going to use almost all of your exemption up, but you're not going to pay one penny in gift taxes. Well, okay, Charlie, so then what happens when they die, say in 2027, when the couple's estate tax exemption is down to $14 million between the two of them, they pass away, but they've given away all that money. Is the IRS going to claw back because they used today's beneficial higher amounts? The IRS has made it clear, I want to say in 2019, that there are no clawbacks, So the point is strike while the iron is hot, and think of gifting today, right? And again, you can gift without even being on the IRS's radar and using up some of your exemption, as in stick to less than the $18,000 per person. So if you have two kids and it's you and your spouse for each kid can give away $36,000, right? Each kid, $72,000. So it's not just $18,000 for couples. It's $18,000 per person per recipient of that. Now, what about irrevocable life insurance trusts? So here's a case that I worked on with one of my top agents out in Nebraska a while back. He said, Charlie, I have a client that's worth $24 million, a bunch of farmland and everything. Obviously, after 2026, which is probably when they're going to die, hopefully after 2026, they're probably going to have an estate tax issue, as in everything above, call it $14 million between the two of them, right? 7 million, 7 million. Everything above that is going to be taxed at a 40% rate, Technically, the estate tax rate, it's progressive throughout the first $1 million that you're over that exemption amount, but let's just call it 40%. That's what everybody calls it. So that means if they're worth $24 million, their exemption is only $14 million after both of them pass away. There's an estate tax due on $10 million in this simplified example. Might it make sense to get, say, a second to die policy, right? Because when the first person dies, there is no estate tax due to the spouse if that's where all of the assets are going. Why is that? Because when it's called an unlimited marital deduction. So when those assets pass to the spouse, it's an unlimited amount that the spouse can get without paying any estate taxes on it. But then when that second spouse passes away, that is when the estate tax is due. So if that second spouse is now worth $24 million, that person passes away, there's an estate tax due on $10 million over the exemption, which comes out to around $4 million. So here's what I said to the agent. Why don't we look at a survivorship policy, an SUL policy, and I vetted a bunch of them nationwide. I love their Index UL. That is also a survivorship. No lapse guaranteed to 120, but I ran the numbers and I forget what the premium came to. But let's just say it was $22,000 per year or somewhere around there, maybe. So what that means is that $4 million policy will pay off the estate taxes once that second person passes away. Now, what happens if that policy is just merely owned by the husband and wife? If that policy is just merely owned by the husband and wife, then that $4 million death benefit is also going to be included in their estate. We've just worsened the issue, right? So what do? Well, that is where we would set up an irrevocable life insurance trust. Irrevocable trusts are different than revocable trusts. Irrevocable trusts, you can think of them as third parties. They have their own tax ID number versus revocable trusts. This is like a third party. And by the way, folks, the trust should be set up first, and it should be the trust that actually applies for the life insurance policy. Why is that? Because if you set up the life insurance policy first, if you're an overzealous agent and tell the clients, hey, set up the life insurance policy first, and then later we can just transfer that to the irrevocable life insurance trust. Well, what the IRS says is if death happens within 3 years, then that death benefit is pulled back into their estate. And because there were assets gifted to that trust, assets of life insurance ownership gifted to that trust, and they died within 3 years of that happening. Instead, it's better to have the trust from the beginning set up that life insurance policy so you don't have that 3-year rule, that 3-year look back rule. So that's what the irrevocable trust does. And that $4 million that will come in after both of their deaths, you are able to use those funds to offset the estate tax liability that will later be coming in. Another thing that I once saw is this, Crummey provisions in the trust. You see, so when a person pays, when Jane Doe and John Doe pay for that life insurance premium, let's say it's $20,000 per year. Well, are they using up their gift tax exemption? No, they're not, because the two of them together can give away $36,000. Now, there's a rule that says but it has to be a present interest. It has to be a gift of present interest. And a future life insurance payment is not a gift of present interest. And therefore, typically, Mr. Client, Mrs. Client, you don't get to use your $18,000 exclusion. So normally, this $18,000 or whatever the premium was, $22,000 per year, that will go against your exemption. However, there are exceptions, and that one exception is this. So there's something called Crummey provisions. And what the Crummey provisions are is it says, well, you can make that gift of life insurance premium into the trust a present interest gift and thus satisfy the Crummey provisions or satisfy the IRS by these Crummey provisions. And what are Crummey provisions? That is where Crummey letters, they're called. Crummey is based off of some court case many years back. These Crummey letters go out to the beneficiaries of the trust each year. So those that are ultimately going to get that $4 million death benefit from the Irrevocable Life Insurance Trust, they need to get letters that basically say, you have a period of time to where you can cash out those life insurance premiums that we just paid. So a 30-day period of time to where you, the beneficiaries, Jimmy Doe and little Jane Doe, you know, the beneficiaries of the Irrevocable Life Insurance Trust, you can cash it out within 30 days. And what that does is that turns it into a present gift. That turns it into a present benefit. But what's going to happen? What should happen is those beneficiaries should not take that opportunity to take the life insurance premium and use it themselves instead of it actually going into the life insurance policy and funding the trust the way that it should. So that's a way around, a perfectly legal way around this rule of, but it has to be a present interest gift. So there are a few things there. I've seen irrevocable life insurance trusts that did not have Crummey provisions in there. What does that mean? It means that that premium is going to reduce their lifetime estate tax exemption by, well, whatever they're paying into that. No annual exclusion amount without the Crummey provisions. But the other thing that I mentioned is the trust should own the policy from the very beginning of that policy's life. But in short to all of this, and this is a lot of stuff here, I get it. Let me know if you have questions. In short to all of this, there are huge opportunities that exist as a result of what's going to happen after 2026, which, what's scheduled? Well, what's scheduled is tax increases. Let me know if you have any questions. Feel free to give me a thumbs up and also subscribe. Please subscribe. I want to build my followers on YouTube.